Hey everyone! Have you ever thought about investing? Well, today let's dive into the exciting world of investments and how dividends can give your portfolio a serious boost. If you're new to the stock market, don't worry, I've got you covered. Also, I'll break down the calculations in simple terms so they make sense. So what exactly is the stock market? Think of it as a giant marketplace where people buy and sell shares of companies. These shares, or stocks, represent ownership in a company. When you own a stock, you're essentially owning a small piece of that company. Now let's relate stock ownership to mathematics. When you buy a share of a company, you own a piece of the whole company or a fraction of the company. So, if a company has 100 shares of stock and you purchase 10 shares, you own 1/10 or 10% of that company. Amazing how middle school math skills can be used in the stock market. Now let's talk about ETFs, or exchange-traded funds. ETFs are like baskets filled with different stocks or other securities. They allow you to invest in a diversified portfolio without having to buy each stock individually. It's a great way to spread out your risk. All right, let's get to the juicy part. Dividends. Some companies and ETFs distribute dividends, which are payments made to shareholders from the company's profits. It's like getting a bonus just for owning the stock. Some companies are known for their consistent dividend payouts. Make sure you research companies and ETFs before investing your money. Similarly, ETFs also distribute dividends to their investors. So why are dividends important? Well, they provide a steady income stream and can significantly boost your investment returns over time. In this section, this is where we marry the math with the stacks. Remember, reinvesting dividends can help your investments grow exponentially thanks to the magic of compounding. Before we move forward, let's talk about exponents, compounding, and dividends. First, let's review some definitions and examples. Remember, with exponents, we take a number and multiply it by itself a certain number of times. So, 10 to the third power means 10 times 10 times 10, or 1,000. Maybe you have 10 visitors on your YouTube channel during the first hour your video was released. The next hour, the channel visitors increased to 100 people. And by the end of the third hour, the channel visitors increased to 1,000. This is an example of exponential growth. Now think back to 7th or 8th grade. At this time in your life, you probably had your first introduction to exponents. If you're new to the stock market, compounding might be a new word. Compounding refers to earning returns on the initial investment and the accumulated interest or gains over time. This results in exponential growth because the interest is reinvested, allowing wealth to grow at an increasing rate. Let's use the example of investing $5,000 in an account that earns 5% annual interest, compounded monthly, for 10 years. After 10 years, your investment of $5,000 at a 5% annual interest rate, compounded monthly, will grow to approximately $8,235.05. Using the order of operations and the compound interest formula can help you easily make these calculations for your financial situation. This demonstrates how compounding can significantly increase your wealth over time. Before we review the dividend payout ratio, let's use the same investment example. But this time, let's say we decide to invest in a stock that pays dividends to its investors. Take a look at the chart. The chart illustrates that by reinvesting the dividend and buying more shares of stock, you could increase future dividends, and your money will probably grow faster. If you were ever bored in math class, this is the stuff that may have made math feel more real to you. Now let's take a closer look at the dividend payout ratio. This ratio tells you what proportion of a company's earnings is paid out as dividends. Hey, ratio and proportion are also terms you might remember from middle school math. To calculate the dividend payout ratio, you can use this formula. Dividend payout ratio equals annual dividends per share divided by earnings per share. Let's break that down with a real-life example. Imagine company XYZ pays an annual dividend of $2 per share, and its earnings per share are $5. Using our formula, the dividend payout ratio is $2 divided by $5, which equals 0.4, or 40%. This means company XYZ pays out 40% of its earnings as dividends. Understanding this ratio can help you assess a company's financial health and its ability to sustain dividend payments. A high payout ratio might mean the company is returning a lot of its earnings to shareholders, but it could also indicate less money is being reinvested in the business. On the other hand, a lower payout ratio might suggest the company is retaining more earnings for growth. And there you have it. Dividends can be a powerful tool to enhance your investments. By understanding and leveraging dividends, you can create a more resilient and profitable portfolio. Thanks for tuning in. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more financial literacy tips from Math and Stacks. See you next time.